starting. All attendees are in listen-only mode.
Okay, can you hear me now? Okay, Jerry, thank you. Lane, thank you. Karen, thank you. Scott, thank you. Okay, we have the sound problem fixed. So let me just go ahead and we'll start right back from the beginning. We're going to be covering the American Equity. They were the number 3 writers in annuities throughout the United States in 2013, 2012. They are the number 1 annuity writers here at Freedom Equity Group. And they have incredible annuities. And we're going to start talking about their lifetime income benefit strength, the riders, and then we're going to go into the bonus gold, the retirement gold, and the foundation gold. First off, let's take a look at the roll-up rates on the riders inside these annuities. Inside of these annuities, you're going to have roll-up rates of 4%, all ages, 6.5% and 7% for clients that are 50 years of age and above. All the roll-up rate calculation fees except for the 4%, which is free. So you can have that 4% roll-up. All of the additional calculation roll-up fees are deducted from the contract value itself, not from the income value. There is no forced strategy allocation, so that when you pick a lifetime income benefit rider, you're not placing your money into a fixed strategy. You can choose a fixed strategy. You can choose an index strategy. You'll always receive the higher of the 2 calculations that will be working simultaneously at the same time, which will be your contract value and your income value. So when we take a look at this, withdrawals do not cancel out the income value rates. This is going to be very important when you want to excel the guaranteed income values in your clients' policies over a period of time. When you start that withdrawal, it does not stop the roll-up rates for the income account value. You have up to 20 years of guaranteed income account value rates for the 4% or the 6.5% option. Income payout is not a point of sales decision. And what they mean by that is the income payouts are decided when, if ever, the clients decide to take a guaranteed income that they can never outlive, that they can stop and or start at any time that they like. So that decision is going to be left with the client. So let's take a look at our compounding, at our values. Let's see here. Let's take a look at our lifetime income benefit option. 4% on the American Equity bonus gold, the retirement gold, and the foundation gold. The 4% income roll-up rate is compounding. It's actually triple compounding. It's not simple interest. There are no fees on the income option. Everyone who receives an American Equity annuity on the bonus gold, the retirement gold, or the foundation gold automatically gets the 4% income account value roll-up for absolutely free. It has a level and increasing option, and it has a single and joint payout, the 4% compounding. If they wanted to have the death benefit payout is 70 basis points, but someone might say, well, Bill, what is the death benefit payout? No matter what the index value strategy, how it performs, that account's going to roll up at 4% at no fee to determine future value of income, or it could roll up at 4%, triple compounding at 70 basis points, not to come out of the income account value, and that can be paid out as a minimum of a death benefit option that will grow at a guaranteed rate of 4% as long as it's paid out over a 5-year period of time, and any reductions of withdrawals would also come out at that time. So as we take a look at it, and a lot more of this information will come clear when we do the actual illustration on our lifetime income benefit option at a 6.5% roll-up rate. This will be compounding, actually triple compounding, not simple interest, at 75 basis points coming from the contract value, not the income account value. This income option will have the opportunity for level guaranteed payments or increasing payments for inflation. Once again, as long as you take the guaranteed income, once that income starts, it can never fall below where it starts unless you take out withdrawals up and above the guaranteed income amount. Every year it could potentially go up, but it can never ever go down. But if you take the increasing option, it will grow every single year. Your clients will get a higher income value, and that is to help adjust for inflation. It also has single and joint paid out. Single and joint paid out means that if it's on a single individual, it's going to be a lot higher income value per month, monthly, quarterly, semi-annually, or annually. If it's a joint paid out, it's going to be spread over the spouse's life. So both individuals will enjoy the guaranteed income that they can never outlive for their entire life. And that is 75 basis points. Also at the same 6.50% compounding at 85 basis points fee, we're going to add the well-being payout option. For a single, that's 200% more than what they're going to receive. And for a joint, it's 150% more, and it has a 5-year max benefit period that those clients are going to receive it at. And we'll go into a little bit more into details on those payouts and how they actually work. The third income account value option that we have is the 7% triple compounding at 90 basis points. That means the income account value is going to roll up at 7%. Guaranteed, never will be lower than 7. Could it be higher? If the index performs higher than 7, or over the period of time, if the index averages 8%, and our guaranteed roll-up rate is 7%. We're still going to have two calculated values going on simultaneously at the same time. And if that value is higher on the contract value than our guaranteed roll-up at 7, the guaranteed income is going to be valued on the higher of the two columns. So the 7% compounding is going to be at a 90 basis point fee taken from the contract value, not from the income account value. The income options also will be level, increasing, single, and joint payout. We also add, for an additional 10 basis points, we can add the well-being payout option. That's a total of 1 basis point, 1%. The well-being payout option, once again, single individual, 200% more, joint, 150%, and this is a 5-year max benefit. It's like a chronic illness living benefit that's going to double the income for the income receiver for a total of 5 maximum years. So let me give an example. Let's say that I'm cruising along and all of a sudden this well-being payout option takes effect, and I'm receiving $22,000 a year. If I'm single, taking that $22,000 a year, the single payout, that 22 goes to 44. If I'm joint, and let's just use that number 22 again, it's going to go up 150%, so they're going to add 11,000 to it. So now I'm getting 33 for the next 5 years for a maximum benefit payout. Very simple to understand, and it's all laid out in the beautiful brochures and on the actual website of American Equity. Now when we take a look at our #1 selling annuity in the United States today, and this doesn't mean it's available in all states, but it is the #1 selling annuity that I know of all of American Equity, and probably one of the top 5 in the entire United States. It's our bonus gold, where we give a 10% premium bonus on all first-year premiums. This bonus is given to the client day 1, and it belongs to them. It's not a vesting bonus over a period of time. So if your clients put $200,000 into an annuity, the day that that annuity is opened up and its effective date of once the money is received, that client's account value is now $220,000, waiting for that first year's interest credited gains rate of return on the $220,000. Once it's given to the client, it cannot be taken back away from the client. There is no vesting period. Issue age on the bonus gold annuity is 0 to 80 years of age, qualified and non-qualified funds. Minimum initial premium to start or open up a bonus gold account is a minimum of $5,000, and then they can make continuous premiums. This is not a single premium annuity. It's a flexible premium indexed annuity, so they can add additional dollars once they have the account open. Maximum premium from 0 to 69 years of age is $1.5 million. Maximum premium from 70-74 is $1 million. Maximum premium that the company will accept from any one individual between the age of the 75 and 80 is $750,000. This contract has a surrender charge with a contract term downgrading from 20% to 17% over the next 16 years, downgrading to 0. Now, a lot of times people will ask me, well, Bill, is my clients better off going into a 10-year product? Contract terms really there to protect the clients because the clients get the annuity, they get the safety, they get the security, they get to have their money grown tax deferred, triple compounding. It handles qualified and non-qualified funds. They have a guaranteed income that they can never outlive, which, by the way, they do not get in a mutual fund, which, by the way, they do not get at the bank. They do not get a guaranteed income that they'll never outlive. Even if the account value goes to 0, they still have a promise from the insurance carrier that they'll get that check every single month like clockwork for the rest of their entire lives. So sometimes when people do ask, well, what if we put them in a 10-year product instead of this longer-term 16-year product? My question to them is, what are they going into the product for? Are they going into it for a long-term to have a guaranteed income that they can never outlive? And if their answer is yes in that situation, I would say they'd be absolutely foolish not to take 10% premium bonus up front because we just added 10% to their account that same day. And that 10% that we added to that account that same day is going to compound at this roll-up rate. If it was a 7% roll-up rate, at a minimum guarantee of a 7% roll-up rate on that income account value in the first year. Now, if you do the calculation, if I give you a 10% bonus, if you don't take the 10% bonus and you go for a product that has no bonus, but you're really putting your money into the vehicle for a guaranteed income that you can never outlive, or to get the highest value in case you ever need the dollars for whatever it might be in the future, you can look at it this way. On the income account value, which is really there to calculate your income growth, it's going to roll up at a rate of 7%. So after the first year, you'd have a 7% rate of return, and then the next year it would compound on 100,000, would compound on 107,000. Well, when I take the 10% bonus, and I really wish I could just lay this out for you on the whiteboard, let's just take that same 100,000. So that same 100,000 that goes into the account, I give them a 10% bonus day one, plus we have the 7% income account value roll-up rate because I don't know what the rate of return is going to be on the index value, so I'm only going to show them what the guarantees are. So I have a 7% roll-up rate. What's my effective rate of return on the income account value after the first year? Almost 17.50%. I don't know anywhere in the world that a client can go and get an income account value that's going to determine their future income that's going to be at a guaranteed 17+% after the 365th day of owning that annuity. So when we take a look at surrender charges and contract values, we also have to take into effect that they're getting this incredible bonus day one. Now on our retirement goals, this is an 8% bonus on all first-year premiums, but this one has a 14-year vesting schedule. So on the retirement goal, the bonus is included in the death benefit value in case the client dies. The contract value, 10% penalty-free withdrawal, TIR 100 and NCR 100s. And as we look at the retirement goal, it's going to be set up a little bit different. The issue age is 0 to 78 for qualified and non-qualified funds. Minimum $5,000 to open the account, and it's also a flexible premium annuity, which means it can take additional funds. Maximum premium 0 to 69 up to 1.5 million. Go back. 70 to 74, 1 million, 75 to 78, 750,000. But you'll notice here that we have a surrender charge in the contract term of 10 years, downgrading to 0 in the 11th year. and the surrender charge starts at 12.5% and downgrades to 0 by that 11th year, instead of 20% downgrading to 0. But we also have a vesting schedule, which this product will vest over that period of time. They will get the 8% credited to their account day one, but they will have to hold the product to term to get the full vesting of that 8% in case of early withdrawal. Not in case they die, both on the 10% bonus and on the 8% bonus. If your clients go into this product today, and for whatever reason, I know nothing's going to happen to them, but let's just say something happened to them 30 days later, that account value and that 10% belongs to their beneficiary. Absolutely no surrender charge and no penalty. So now let's take a look at the benefit goal. This is a 5% vested day one premium bonus. Once it's credited to them, it cannot be taken back away, and it does not have a vesting schedule. This product here goes from 0 to 80 qualified and non-qualified funds, minimum $5,000, maximum premium, once again, 0 to 69 up to 1.5 million, 70, 74, 1 million, 75 to 80, 750,000. This also has a surrender charge on a 10-year chassis, downgrading from the first year to the 10th year at 13.25%, downgrading to 0 by the 11th year. This is a 5% single premium bonus product. It also has a 10% penalty-free withdrawal available to it, and on all of these products, the bonus gold, the retirement gold, the benefit gold, and all of American Equity's other products, you can add the 4% roll-up rate on the income account value, the 6.5% roll-up rate on the income account value, and or the 7% roll-up rate on the income account value. Then we have our foundation gold. We have a product that will fit every single one of our clients' needs without looking outside of the box to any other carriers. So on our foundation gold, this is a 7% premium bonus product on all first year's premiums, and this has a 10-year vesting schedule. Even though the 7% is going to be credited day one, in case of early withdrawal, it's going to be placed on a vesting schedule and could be clawed back depending upon their withdrawal or if they surrendered the product early. So the premium bonus is a 7% premium bonus, applies to all first-year premiums. This, once again, is a flexible product. Bonus vesting schedule, 10-year straight line, 0% to 100. So the 7%, 0 bonus would be vested in the first year. The first year, they wouldn't get any of the bonus. It was credited to them, but they did not receive it because they surrendered the policy. If they was to die within that first year, it's written in the contract that they would receive the entire 7% bonus. Then we have it vesting in the second, third, fourth, fifth, sixth, all the way up to the 11th contract year. On the 365th day of the 10th year, on the 366th day, it would be a 100% vested bonus over that period of time on the foundation gold. This is a 10-year surrender charge product starting at 9% surrender charge, downgrading to 0 over that 10-year period of time with a 7% premium bonus. The 10-year bonus vesting schedule, issue ages 0 to 80, rates are the same as the retirement gold, 1.5 million, 1 million, and 750,000 depending upon age, with the availability of all the IVR riders, the well-being, and the enhanced death benefit riders can be added to all of these products depending upon which state that you're in, okay? So a lot of these products are state-driven. Every state has a different definition of what they think is the best thing for the client. So we had to design products that would meet the requirements of each individual state. So the foundation gold also has a 5% penalty-free withdrawal, which accumulates to a 10% maximum, while the other, the bonus gold, the retirement gold, and the benefit gold, has a 10% penalty free right out of the gate after the first year. This one has a 5% that accumulates to 10% in the second year. Accumulates is only no pre-withdrawal was taken in the previous years. Every state will offer products with a 10% penalty-free withdrawal. So as we take a look and we come to the end of our slide presentation on the American Equity, what I want to do now is I want to go to our American Equity Income Account Value Calculator. So let's say that we're sitting with a client. One of the biggest needs for a client today is to have an income stream that they can never outlive, to have money that's going to be there when they need it the most in case they need to spend it. Well, we cover all of those areas. I can't give them a value outside of the income account value, what their contract's going to receive and a rate of return. And if anybody actually gives them a value outside of the fixed interest rate value, it's going to be a speculative value. It's going to be speculation only because nobody can foresee the future of the index market, whether it's the S&P 500 and Dow Jones. We're just in the unknown. But historical performances have shown incredible rates of return for our clients year after year after year. But one thing that we can do is we can guarantee our clients an income stream that they can never outlive. So let's take our client, Mr. or Mrs. Client, and we have our incredible agents. And let's just say that we're going to be in the state of California, and the program's already working. So if you're in the state of Texas, and for whatever reason you're trying to put in one of the products and it's not working in the state of Texas, that's probably because it's not available in the state of Texas. Okay? So let's just say that our clients need a guaranteed income stream that they can never outlive. They've saved up a great deal of money. They no longer want to take risk of that money inside of the markets. They don't want to go for the low rates of returns inside of certificates of depreciation, which is also known as CDs or bank accounts or savings accounts. They want to get a great rate of return on their income account value that they can determine a minimum that they can get for the rest of their entire lives as income. So we're going to click in here, the lifetime income, and let's just say we want this payment to come to them on a monthly basis because it seems that most individuals throughout the entire United States, at least 99% of the population that receives income receives it on a weekly and a monthly basis, and that's how their spending habits have continued for their entire lifetime so that they're used to getting that check every single month. Now we're going to go down here and select the products. These are all the products that are available here in the state of California for these income riders. I want the client to excel. I'm going to put them into the bonus gold. I'm going to get them the highest guaranteed first year bonus and the highest roll-up rate possible because these clients, they want a guaranteed income that they can never outlive. Let's just say that the clients are 60 years of age. Whether it's qualified or non-qualified funds, you're going to be able to click right here, qualified and or non-qualified. We accept both qualified and non-qualified funds. If you think, well, what's the definition of qualified and non-qualified funds? It's very simple. Qualified money, dollars that you've already paid taxes on. Non-qualified funds is money that you haven't paid taxes on yet, but you're going to, like your IRA, your 401k, your 403bs, your SEPs, your 457 plans. We handle all of those types of funds inside of this account, including your Roth IRA, where you'll have a guaranteed tax-free income for the rest of your entire life if it's set up properly. So let's just say that it doesn't really matter in this scenario if it's qualified and or non-qualified. And let's just say we're going to go at the we can choose the 4% for free, the 4% with the guaranteed death benefit in case they die, that they're going to get a 4% roll-up rate for the next 10 years, the 6.5%, or the 7%. So in this case, let's just go at the 7% rate of return with the 5-year payout. And let's just say that level payment, we're going to take it as a level payment. Let's just say that we're going to put in $500,000. Doesn't matter if your client's only putting $5,000, $500,000. Every client's going to be different. They're not going to make any additional payments. Let's just say we want to defer this for 5 years until they're 65 years of age, because they want to see what the minimum guaranteed income that they're going to receive. It could be higher, but it can never be lower than this precise penny that I'm going to show you. All we do is press calculate. We are sitting with the clients, Mr. and Mrs. Client, at on the lifetime income benefit rider payout calculation of 5% with a 7% roll-up rate. We're going to give you a premium bonus of $50,000 day one. That's the 10%. And you said you wanted to take out the guaranteed income starting at age 65 years of age. We're going to guarantee you $38,570.17. It can never be lower than the $38,000, but $570.17, but it could be higher based on the income, the contract value. Now, if all I did was went down here and said, well, what if the client didn't take it in the 5th year and they decided to take the guaranteed income in the 6th year? Well, then that's a guarantee of $41,000, a huge increase from 38%. Well, what if they didn't take it in the 6th year and they deferred it for 10 years until they were the age of 70? Then they're guaranteed $59,506.33. Well, if you think about it, their original contribution was $500,000, and they're going to be guaranteed for the rest of their life, no matter how long they live, at the age of 70, a minimum of $59,506.33. And that's an annual payout. And of course, you can calculate it into the actual monthly payout. And the clients will receive a check monthly, quarterly, semi-annually, and or annually based on what they would like to see. Now, can we even stretch this out farther? We could. We could defer it for 10 years just to get the actual numbers up there. Then if we deferred it for 10 years, that's going to show that the income calculation is going to be based on a 5.5% factor, still the $50,000 bonus because of the 10%, and still the annual lifetime income is $59,000. Now, everybody knows that inside of a checking account or a savings account, if I put $500,000 in a checking or a savings or in a CD, probably over the next 10 years, that account would probably be worth about $550,000, maybe $600,000. If you were lucky, because interest rates are incredibly low. And if I started taking out $59,000 a year on a $600,000 account, I would probably drain my account to a zero balance going into the 11th year. If I drain my account to a zero balance going into the 11th year and I'm only 81 years of age, what am I going to do then? I'm now out of money. If the same scenario happens here and it's written in the contract, if my account value goes to zero, the company will still pay me $59,000 a year until I die, no matter how many years I get to live. That's a guarantee coming from the insurer that nobody else is giving from the banks or any other type of retirement program with a guaranteed income that you can never outlive. That's one of the strongest values that you can get, and you can never outlive this guaranteed income. So as you can see, there's a lot we can do here. There's a lot of different products. This is one of the strongest income calculators that you can have. Let me take a few questions. Question number one is, how would the penalty affect my 60-year-old client should they decide to take an income at age 70? Very good question, Sam. If they decide to take an income at age 70, there is no penalty. We also for qualified and non-qualified funds. We also understand that there are required minimum distributions. You do not get surrender charge and or penalized on that. You can have a client that opens up an account at age 70, and we can start the required minimum distributions at age 70 and a half, which according to the law, we have to do that, and there are no surrender charges on that. So it does not affect, there are no penalties, it does not affect your client, but that was a very good question. What is the minimum years for deferment before they can start taking the income? The minimum years is 1 year, 366 days later after they open the account, they can start taking a guaranteed income stream that they can never outlive. So, and then that guaranteed income stream factor is going to be determined on their age, just like the 70-year-old. If you're 70 years old and you walk into a bank and say, hey, I want you to give me $5,500 on my $100,000 I'm going to give to you for the rest of my life, that would be a 5.5% rate of return as income on that $100,000 for the rest of your life. The banker would say, absolutely not, we can't do it, can't afford it, and get out of my office, you're crazy. Get out of my bank. That same $100,000, that same 70-year-old on the 366th day, we're going to give the 5.5% on that $100,000 plus a 10% bonus. It's going to come up to be about $5,600 guaranteed for the rest of their entire life, no matter how long they live. So as we take a look at some other questions, what if the client dies in 10 years? Very good question, Scott. It's like anything else. If the client dies in 10 years, if they had a single guaranteed and they were taking the income stream stops. The contract value of all the money that's left in the account flows directly to their beneficiary, avoids probate, avoids court costs, avoids expenses, and somebody's very happy inside of their family. If it's on a joint basis and the client dies in 10 years, then the spouse can elect to continue the income stream, or the spouse can elect to take over the actual contract. Unless it was on a joint basis, they'd just still be getting the income that comes in. So once again, in a scenario like that, it's a win-win for the client. So very good question, Scott. Would the income account value grow at 7% on the 6th, 7th year max? Yes, the income account value will grow at 7% for the 5 years, and then they can renew for another 5 years. So all of these have renewal periods. Some are 10 years, some are in 5 years. They can actually go up from 7, where they might be able to elect a 7.5% roll-up, but they will have a chance to renew, and they can have it roll up for 10 years if they want to. Okay? So the next question, what is the minimum deposit? On all accounts, Louis, the minimum is $5,000 to open up the actual annuity. Please explain the BPSs on the different tiers of returns from Scott. Scott, the income account values roll up at the 4, 6.5, and 7%, but there's a cost. For the 4% roll-up rate, there is no cost. It's automatically added to every single policy. But if your client wants their income account value to roll up at a 6.5% guaranteed for the next 10 years in a row, it's going to cost them 70 basis points that comes from the contract value. So it never will ever disrupt their income. So it's not like they're getting 6.5 minus 70 basis points and they're getting 5.80. They're getting the true 6.50%, and that's where your income is calculated from, unless the contract value in the S&P 500 index and the Dow Jones has performed better, and then it's going to be calculated from the higher of the two. Another excellent question, Scott, and it's just the same for the 7% roll-up. It's going to cost a little bit more than 6.5% roll-up because we're guaranteeing them a 7% income account value rate of return. So that's another excellent question. So with that, we have a great deal more questions, but I can't get to them all. This is just the start, and to introduce you to 2014's lineup at American Equity, one of the top carriers in the industry. the #1 service provider in the industry, brought to you by Freedom Equity Group. If you're not contracted with them, I would definitely get online, get your contracts, get with the person that invited you. We're going to continue onwards with the American Equity training. I'm going to show you how to max out your income. I'm going to show you next week how to take this 38,570 or the 59,506 and get 20 to 30% more guaranteed income out of this exact product that we're looking at for your clients, guaranteed. So with that, I'm going to leave you with that, and hope to see everybody on next week's call. If you need anything, you're more than welcome to call our office and our 800 number. And let me give you everybody our 800 number here at our office. That 800 number is 877-329-6608. And remember, next week's call, we're going to go over a little bit more of the American Equity. Then we're going to show you how to increase the income to your clients by 20 to 30+% more than what they can get just by using this income account calculator. Once again, everybody have a great day, and we will see you on next week's call.
The organizer has